Welcome everyone to How Business Owners Can Attract the Right Type of Capital. I'm your host, Brandon Chapman, and principal of SAS Wealth Insurance. A little bit of housekeeping. Today's session will be recorded. So if your most important client calls, don't worry, you'll receive the recording tomorrow. If you have questions during the session, you can post them in the chat or ask through the Q&A function below through Zoom webinar. Feedback is always appreciated, as well as ideas for future webinars. So please let us know what you think of the session today. This is the second webinar in our fall webinar series for business owners. If you missed our first session or are interested in the third, how business owners can use content marketing to grow their business, please visit the URL listed here. This URL will be emailed after our session today. It's a great pleasure to welcome Joshua Tiong, who is presently a partner of Business Advisory with the Business Development Bank of Canada, as well as Dave Savory, co-founder of Riipen. Both are quality professionals that I've known for years. They have a great deal of experience with capital raising, startups, and growth stage companies, and we're fortunate to have them joining us today. As for an agenda today, we're going to talk about the types of capital raising along the life cycle of technology companies. And Joshua will lead us through that. Dave will then share the Riipen journey and the various forms of capital sources they used along the way. We'll then get into a conversation between us with an open Q&A forum regarding the benefits and drawbacks of various forms of capital. I'll now pass the floor over to Joshua.
Hey, Brandon. Thank you so much for having me, and happy to be here today. So what I wanted to present here is more of a, let's take a step back and look at what is the business phase, right, as part of a company's development journey. And so that is everywhere from I have an idea, back of a napkin, all the way through to we have all of our functional departments, we're starting to expand around the world and really build a company. And then we're going to match the business phase with the funding round, as it's kind of commonly known. The definition of that, what are the typical sources of financing that match to that? And then importantly, if there is maybe an equity component where we need a valuation of a business, what are the key valuation drivers? And so the framework surrounding this is based off of the Lean Startup by Eric Ries. So, pretty common within the tech world, within kind of 0 to 1 and 1 to 2 innovation. And so this is focused on the tech growth journey or the kind of innovation-led business, whether it is product or service oriented. However, what we're talking about here easily translates to companies that are in fabrication, services, manufacturing, right? And so feel free to ask the questions as we go along. And I do see some familiar names here among the attendees, so great to have some familiar faces. So in the very beginning, and one also thing, I should credit that the base of what I'm presenting here does come from a course at Simon Fraser University, and it has been put together and compiled by Andrew Harries, who is the Associate Professor of Practice in Innovation and Entrepreneurship. So credit to Andrew for this, and it's kind of augmented by some of the stuff I've added. So the first phase is idea hypothesis. We have come up with an idea. And the key distinction of what this phase means is that we're translating the original idea into hypotheses that are testable in the scientific method about key aspects of the business. And so during the early phases here, this is where people are, as an entrepreneur saying, what is the problem and what do I hypothesize to be the solution to that problem? So typical financing sources, this is super early. This is even before pre-seed stage, right, as it's known. So the financing sources will be bootstrap, your own savings, your hard-earned cash, your time, your blood, your sweat, your equity. It's going to be your friends and family, people who are very close to you, where maybe they don't know the space as well, they don't know the problem as well, but they trust you. There's crowdfunding. And we won't talk too much about crowdfunding, but there are all of these alternative funding platforms where you can do equity crowdfunding. And if you're a product company that's reinventing how, let's just say, a cell phone works, right? Or a kind of pen, a mechanical pen, then you can put together a campaign around a concept. and then that will fund part of your research and development. And of course, with the R&D component, there are universities. So there are universities that have research funding to look into certain problems. So at this stage, the key valuation drivers are going to be, what is the hypothesis? And importantly, what is the business model or the value proposition that maps to a canvas? And so the business model canvas is a framework put together by an organization called Strategizer. This is the language of describing how companies grow, and it works at all phases of company development. So we use this even for companies that are in the scaling phase of their journey, right? There's also another one by Ash Moria called the Lean Canvas, which is a similar type of canvas, but very specifically for the first stage where we're testing hypotheses. So having this exercise done, thought through, and something you can present is a key valuation driver. Next is ideas change, right? And so your credentials as a founder is really important. If you're tackling a problem in the legal space and you've worked as a paralegal and then done your LSAT and then practiced law in a firm, small firm, and then to a mid-sized firm, your credentials to say, I understand and have felt and have heard my friends feel the pain of this space. Your founder market fit is quite strong here. And of course, there are the advisors in the space. So who has subject matter expertise, problem space expertise, business model expertise, stage specific, right, solution specific expertise that you can lean on as a part of your formal advisory team. These are all valuation drivers under the idea hypothesis phase. So the next one is customer discovery and validation. So definition here is we are testing, and importantly, we are calibrating the key hypotheses. So what are these hypotheses? Let's continue to gather observations, evidence, surveys, shadowing, like there's all these kind of qualitative methods by which we're evaluating the hypotheses and gathering evidence in support of, or, as evidence contrary to these hypotheses. And all information is good at this point, right? Customer validation is talking to customers, people who are going to be paying for this, people that you want to be using or paying for. And this could be the buying group and it could be the user group. And it's important to distinguish between these two. There's PM fit, which is product market fit. So product market fit is, how do we productize this? How do we make this into something that is commercially able to fit to a market sector opportunity? Right? And then there's a viable business model. So it's extending that business model canvas down to the specific round is we're now starting to implement and put into place the building blocks, whether it's the key resources, the IP, it's the asset base, it is the brand, right? Like what are the key things that drive to make this business model feasible? What are the key value propositions that must be delivered to certain customer segments? And if any of this language is not familiar, do look into the business model canvas. It is kind of a reference to all of that. And the important distinction or kind of trigger that moves you very far into customer discovery and validation is you have a paying customer, not paying for pilot, but ideally paying at some sort of a commercial rate with some sort of a commercial agreement in place. And so funding sources as you're navigating this round are going to be incubators and accelerators. These might be university domiciled, they might be sector specific, they might be global, they might be problem space oriented, stage specific, but these are incubators and accelerators where they are either done out of the goodness of investing into a sector for a particular agency or a particular kind of region or government, or it is done to advance academically, or it's part of an investment fund. Right? But all of them are there to provide a structured method by which you work through customer discovery and validation. And then there are government funding sources or pseudo-government funding sources where it's a combination of public and private funding. So IRAP is with the NRC, right? They provide some kind of industrial partnership with testing out hypotheses and what is coming from research. WD is Western Economic Development, and specifically here for BC-based businesses, there's Pacific Can, right? Pacific Can, which is the same thing. It's an ECDev agency for Pacific-based businesses, which is Yukon and BC. And then angels that are in your network, people that you know who are accredited investors that invest themselves and their money. So it's not only their money, but their time that goes into supporting. And so these are really hands-on advisors that get really involved with your business in exchange for equity, right? So in exchange for some upside. And then the valuation drivers at this stage are going to be, again, what is that evidence that is giving us customer validation, both for and against our hypotheses, so that we can continue to refine them. There's the product market fit. A viable business model is confirmed. So we have mapped out the business model, and the business model has three key kind of facets that we look at. Number one is in the value proposition, customer segments, and customer relationship and channel delivery, is it desirable? Do people want this thing? Is there a pull from the market, right? Is it real as an opportunity? And then the second facet is looking, behind the scenes. So imagine you're looking at the back of the theater. You've got stage hands, you've got costume designers, you've got people changing the sets, the stage kind of design. All of this is to do with the operations, right? So we're looking at the key partnerships that are in place. What do we build, borrow, and buying? What are the key activities that we do ourselves? What are the key resources that we own, that we have control over, that map to the value proposition? And this talks about the feasibility of the business model. Can we deliver it? And then there is the question of between the revenue streams and the cost structure that we have, is it viable? Do we bring in more money than money going out? So fundamentally on a business model, these three boxes must be checked. It is desirable, it is feasible, and it is viable. So at this point, there's a first paying customer. We're not necessarily making money on the business, but we know the business model will when we add more customers to it, right? Fill in the sales and marketing hopper and team credentials, because we now have a co-founding team. We have early employees, and maybe we have a ghost team, right? So people that we've talked to who are very interested in this, but they would get involved and they would add more value by getting more involved at a later stage in a company's journey. And so at these two kind of stages, what we're looking at is number one, problem solution fit. Is there a fit between the solution that we are applying to the problem, right? And then they're looking at product market fit. For the product, right, how we've productized this service or solution relative to the market opportunity. Is there a fit there? So next slide, Brandon. The following slide that we're looking at, the phase is called customer creation. We've now sorted out, we have a minimum viable product. People value this. They want to use it. It will make a difference to solving some sort of a problem they have. Whether that problem is a job to be done, it is to make what they do more efficient, it is to bring down their cost, it is to make their life richer and more meaningful, right? It doesn't matter what it is, but the value is important to these customer segments. So what we're doing at this point is we're trying to add business to the hopper. We're trying to originate new business. We're trying to get this in the hands of people so that we can quickly iterate through it. And so what we're doing at this phase is we're adding we're adding product development capacity in the business, which means we're starting to bring in some specialized functions in the business. And if this is a kind of equity-based, capital raise funding model, then a board of directors starts to become formalized at this point. And so the board of directors is typically going to be, an odd number, so 3 or 5 typically at this stage. And you're going to have, let's just use the example of 3. You're going to have somebody who is a founder in the company, one of the founders that represents the voice of the founders, somebody who is nominated to represent the voice of the investors, and somebody that is nominated to be a third party, right? So somebody that can tie break in any sort of a voting situation. So this is important to ensure that the interest of the investors, current and future, and the interest of the founders and operators and hustlers and visionaries of that business are aligned, and that there's a tiebreak who is able to look at this, as a full business opportunity that balances these two interests. So the funding sources start to get a little bit more complex, and we're starting to look at more equity-based options, right? So we're still burning money at this point typically. And so angels, instead of individuals who are writing checks between 25 and 100,000, you're starting to look at angel syndicates. These are groups of angel investors who have come together, pooled their monies into funds that are able to write larger checks. And they're going to do the same sort of due diligence. They're going to do the same sort of, investment thesis when they're looking at opportunities. But at the same time, the angels can also participate on the side. So the angel syndicate might say, we'll write a $500,000 check to support what you're doing. And at the same time, one of the angels is going to hop on, right? So the angel syndicate leads, and this individual joins and participates in that round for an extra 150K, just as an example. And so this is where angel syndicates are great because they're bringing together, typically 100+ angel investors. And so you get more expertise, more access to advisors, more access to networks. It's really great to work with angel syndicates because, like the name suggests, they're here to help, right? And in exchange, of course, for equity and upside, but they're doing it typically because angels are people who themselves have made money from some sort of venture, and they recognize that it's taken a village to get them to where they've gotten, and they want to now be part of that village that's building up the next generation. Financing source is customers and partners. So this is an interesting one because fundamentally what we're doing when we sell a product or a service and somebody pays for it is the customer is giving us money. That money is reinvested to actualizing this business model, right? So they are actually funding us. It's a source of funding. You're not giving up equity, but you need to deliver the value to these people. So customers and partners that are giving you licensing fees, product sales fees, et cetera, that's another source of funding. It's one of the critical ones during this phase. And then there's, again, government. So you're looking at IRAP funding, you're looking at your ECDEV funding, you're looking at SHRED, which is a tax credit. You're also looking at grant funding, right? So there's a whole bunch of different government funding sources that become relevant at this point because more risk has been taken off the table. And this is also where venture capital starts to become quite interesting. And I won't go into what venture capital is because it's commonly known, but the easiest analogy that I like to liken this to is venture capital relative to other forms of kind of early equity investment or debt is regular fuel versus jet fuel. Venture capital is we're going to inject a ton of high growth money with high expectations because we need speed. We need to accelerate it. And so if you think about putting, jet fuel into a Volkswagen Jetta, it's not going to make much of a difference. You need a rocket ship. So the rocket ship has to have been built, or the large part of the engine needs to be there. And so you can still kind of fine tune some of the instruments, but the rocket ship itself needs to be there, right? And the key valuation drivers here are going to be your minimum viable product is shipped. It is something that can be sold. It is something that is iterated on and improved, but it can be sold as is. So you're starting to build sales and marketing. Your go-to-market fit. So how do we get found? How do we get what we sell into the hands of people who want to buy it? And we're starting to think about, we don't want to just get sales. We need a repeatable sales process, right? So the number one thing before something is scalable, it needs to be repeatable. When it is repeatable, it can then be grown. When it is grown with a strong infrastructure, then it can be scaled, right? You need to understand your marketing and sales numbers. What does it look like when you are managing your portfolio for land and expand? What does it look like when you're expanding to acquire new business? So what's our pipeline math, right? So M&S here is marketing and sales, and PDM is product development management. So the key distinction between PDM and PMM is PDM works with research and development, and PMM works with marketing and sales, right? But both are in service of driving the P&L on that particular product line. And then here you're formalizing, again, the board and the advisors. What value do they bring strategically to augmenting the value of your business and increasing your chance of success? And finally, in the last phase, we're looking at building a company. So this is formally called a company building phase. So we are moving from startup mode, which is like, we're building it, right? We're building it as we're going along, to this is a company. We need some, frontline management. We need some middle management. We need standard operating procedures. We have an employee manual. We actually have, employment agreements in place. We're building a company. And so this is the phase where a lot of founders and business owners start to feel like, I don't know if this is what I signed up for, right? Like I wanted to solve a problem. I wanted to really, work through and be a risk taker. I don't know if I want to be corporate. We hear this a lot, but this is what it means to build a company, right? So we're building functional teams. We're building HR. We're building accounting and finance. We're building a formal marketing team. We're building a strategy team. So these things start to become really important because you need corporate functions in place. We're hiring sales reps. And again, in the previous phase, we're figuring out our pipeline math. How much does it cost us to add a new lead to the hopper? How much does it cost us to bring a lead and make it into an opportunity? How much does it cost us to qualify and convert opportunities into sales, right? So we've already figured out and gotten some pretty good evidence behind this pipeline math. So we're hiring sales reps because we want to just get dollar in, dollar out. So hiring sales reps fundamentally is, if I put $1 into my vending machine, I know with a relative certainty that I'm going to get $5 out, right? And you want to always be improving that math. So just imagine $1 into the vending machine, $5 out, and I have a 50% certainty. So the expected value from a kind of finance perspective is $2.50. So what we always want to do is increase that $5 out for the dollar in, and the confidence that we have that we're going to be able to make this happen. And so that's hiring sales reps at this point. You're going to ramp marketing spend. So that's more to fill up the hopper, and sales is about converting that. And then scaling up. So you're running the machine at this point, right? There's a system in place and you're going to just keep pushing. So at this point, it becomes really interesting because you could be still looking at venture capital. These are your series rounds. So your series A, B, C, D, E, and we're seeing some pretty large letters there. But there's also venture debt, which is sometimes called subordinated debt, or it's called mezzanine capital, right? It's growth capital. People call it all sorts of different stuff, but the type of security and financial instrument are things like convertible notes, right? You're looking at participating preferred, instruments. You're looking at things that are pretty flexible as far as a kind of like term structure and how the repayment is done. But all of this is in service of we're scaling, right? We're making the marketing and sales and delivery math work. And then there's private equity, and private equity is really another word. It's similar to venture capital, but private equity typically comes at a later stage, and it's sometimes thought of as family offices as well, which are private equity funds that are managing a private family or group of families' wealth, and they make investments into whatever their investment thesis is. And then there's your IPOs or company sale, so your mergers and acquisitions. So this is standard. Of course, there are lots of other things. There are, kind of your tokens. There are your coin offerings, but this is the traditional what we typically see. And the valuation driver at the company building phase, this is where kind of finance that you study, right? Your discounted cash flows, your comparables analysis start to become really relevant. Previous to this, it's all about potential. And this is about realizing that potential and seeing what else are we building on the horizon. So your metrics really become important. What's your revenue? What's your growth rate? What's your gross margin? What is your, these are called traction metrics. What is your cash flow, right? Within any sort of a research body like Gartner or Forrester or any of these ones that place people who are providing solutions relative to a problem space onto a quadrant. So in your market, are you providing thought leadership? Right? Is there a ton of upside potential? Is there an opportunity for you to move to new geographies, tackle new market spaces, expand your product line, get larger share of wallet? So this is strategic value. So there's kind of core operational financial value, and then there is strategic value for how can we extend the business model. So I'll stop there. I think there's a lot more to talk about, but I'll wait for the Q&A.
Thanks very much for that, Joshua. I agree. There's definitely an academic side when it comes to running a business, and there certainly is the operations and actually making it happen. Joshua, you've definitely seen both, but I appreciate you sharing this perspective because I think it leads very well into the experience of growing from nothing to a company of, I'm not sure Dave can probably allude, upwards of 100 employees. And there's a lot of different pieces that go into that. But I'm sure Dave had some understanding of how some of those processes work and how some of those options were. But he's going to be able to explain a little bit about which options he chose at which points in time and how that worked with him and his co-founder. So first of all, Dave, welcome to the webinar and thank you for being here today.
Thanks, Brandon. Thanks, Josh. Happy to be here.
So you've had quite a journey over the last 7 years, Dave. I guess the first question for you is early stage Riipen when you were just starting to build the business? Where did the money come from and how did you get started?
Yeah, good question. I mean, we started Riipen right out of university, so we were first-time founders. We had operated small businesses before, but never in the tech kind of startup space. And so right out of the gate, we actually leveraged quite a few like competitions and won kind of $10,000 or $20,000 every here and there just to really get things off the ground. But really what we started doing, we were bootstrapped. So we had a technical co-founder and Dana, my business co-founder. And so we were working for a couple of years almost without any salaries or wages or anything like that. And what we did was, to Josh's point, we actually got our first few dollars in the door through revenue, through clients, pitching ideas, finding people in the academic world that really believed in not what we were at that point, but what we were trying to become, and really selling that kind of vision of of how to solve a problem and actually get some funding. I think they're small $10,000 or $15,000 deals, but 3-4 of those in a row before we even had our full-blown product really helped us kind of get the resources to get that MVP up and running and get users trying it and getting feedback for it. And as we were growing and started to see the signs from the market that there was value in the solution and what we were doing, and the feedback was coming in both positive and negative, we decided to raise money. We were creating kind of a new space, so we weren't really building a better mousetrap. It was more of a hey, let's try to get schools and industry partners to engage in a new way that hadn't been done before. So a lot of it was, we knew that like we weren't profitable. We are kind of just at the cusp of profitability now. So like we knew that raising funding was necessary for the type of business and type of market that we were in. So we started our first funding. We did a few different funding paths. We started with Front Funder, Vancouver-based company, equity crowdfunding. And so we really hit the pavement. We treated that almost as like our friends and family round, where we set a goal of 130,000, and we ended up and did a few different road shows and events and really got all of our community engaged. And we had about 52 or 55 funders from as low as $500 to $5,000 or $10,000. And we exceeded our goal. We had $200,000 from Front Funder, and we actually tied that into a larger angel round. And so our first funding in was about 1.8 million was through angels, not all at once. It took probably 8 to 10 months to close that round. But our first angel was, we met pretty serendipitously at a rocket builders class at SFU, Venture Labs. He had joined one of the classes just as a guest. He had run a successful business in the UK and moved back to Vancouver after being away for 20 years and was just trying to learn the technology scene. And we ended up meeting him very organically and started a relationship. And he actually got quite involved he really resonated with the social impact side of what we were doing. And actually, to Josh's other point, became very hands-on as even before he invested, but then once he did invest, he was the first significant angel investor that came in, that really helped us kind of formulate what we were trying to do and how we were going to go and find other angel investors like him to bring them in, and really helped us get that off the ground.
It's very interesting, Dave. And I saw some of this from the sidelines, but hearing it firsthand from you is extremely interesting for a few reasons. And for those that don't know about Riipen is solving graduate underemployment and offers projects for companies to essentially test out students and for students to test out their skills in the marketplace. And they found success initially, I think, in Canada, and now you're in the States and a few other countries as well, if I'm not mistaken. Yeah. So I guess with the Front Funder campaign, there's obviously it's an open forum, so you can get a mixed bag of potential investors. Did you find that the PR from an experience like that was positive for your business, or was there any drawbacks that you see kind of in hindsight?
Yeah, I mean, this was quite a few years ago. This was in 2016. We were one of their first companies. I don't think we were the first, but in the first 3 or 5. And I mean, we invested in it. I mean, an important thing to think about is it's not a, if we build it, the investors will come. You still do need to mobilize and market what you're doing and connect with people and actually really drive it and be ready to put that energy into a campaign that you might launch on Front Funder or even just doing an angel round in general. Like it is a significant amount of work and time and energy that goes into it that shouldn't be understated. Like it is a full-time job on top of all the other things you need to do to run the day-to-day of the business. But yeah, I mean, the nothing but good things to say about working with the Front Funder team. They're fantastic. I know they've even, I'd be curious to go back through their process again, because I know they've enhanced it significantly in the last 4 or 5 years. So, but yeah, no, the media, the marketing behind it was very positive from a branding and just getting our name out there standpoint. We actually hosted several in-person events too, where we invited people in and to spaces and kind of did a pitch and we're able to bring people into the community from that as well.
I love that. It makes a ton of sense. So you get essentially a bunch of free PR as well as you gain some money for your business, and it opens up potential other doors for business development or for capital raising. And in a business like yours, where you are, building a community among the students, the alumni, the faculty, the companies, there's such a community-based ecosystem that I guess it makes a ton of sense why you went that route. Now, you did speak about your first angel that you met through Venture Labs. Can you share a little bit about how the personality fit aligned, and if you have any advice for perhaps founders to find that ideal angel? What did you find worked for you and Dana, and was it easy, or did you have to sell a little bit to get the deal?
I mean, there's always elements of selling to get people interested in even meeting with you and taking time out of their busy schedules to kind of dig in. I mean, you don't have to do as much selling if you're kind of in it and living it day to day and asking for guidance and advice. And our first angel investor, Mohammed, he's still on our board. He chairs our board, and he's had various kind of hands-on roles within the company. He's more of an actual board member now, but in the early days, he was very much like in the weeds with us and was very interested in what we were doing in our space and was excited about the impact of what we were doing, but also his expertise at operating and growing a business. He was able to transfer that and kind of help us implement some ideas and guide us in a way that was really valuable. So you can't really put a price on those kinds of things. So I'd say when you're looking for an angel investor, like there's different kinds of angel investors. We had some come on later on that really literally just wrote a check and we haven't really ever heard from them again. And there's others that are like Mohammed, who it was smart money in terms of like really believing in the people and helping the business grow and interviewing your first employees and like kind of helping really if that is something that they are able or capable of doing and they have experience in that, it's a really invaluable team member to bring on. Does that answer the question?
Definitely. Yeah. And I guess I'm curious a bit about alternative sources of financing along the way. So, did you take advantage of grant programs? Which ones were worth the time? Which ones were kind of too much work for what they were worth? If you have any experiences you can share there.
Yeah, definitely. I mean, we've been pretty creative in that space with just the nature of our space and our product and kind of the impact that it can have. We've leveraged a few programs, not to just give us grant funding to run or operate, but actually to help our customers buy Riipen through RBC Future Launch, through Business Higher Education Roundtable. We just did a $12 million project with the federal government called Level Up. So, I mean, it definitely doesn't necessarily apply across majority businesses or industries, but if you can think kind of creatively of who are your customers, who are you trying to serve? Is there a way, and are those needs and solutions of interest to a funding partner, whether that be a private foundation, a government agency, community group? And then can you, especially in our space, a lot of universities and colleges face budget constraints, and they don't always have money to deploy, even though, and so what we were really good at was demonstrating the bottom up of, hey, we can activate educators to bring more experiential learning into their classroom, but we need a funding partner to really supercharge and kind of plant the seeds of the ecosystem. So we got pretty creative with that, and that really definitely, obviously, it's a bit of a unique situation, but I think there you can think creatively of other types of funding partners that might be interested in helping a group of stakeholders that your solution might help, and exploring that. We did also, at the end of 2019, raise a venture round. I don't know if there's a question coming up about that, but happy to speak about that as well.
Yeah, let's get to that in just a minute. But I find it very interesting that you've managed to leverage the relationships to solve a market problem outside of perhaps what you initially saw was the problem. So you realized, you and Dana and your early team realized that there was people graduating from university that were not ending up in their intended career path because they simply didn't have the experience. Companies asking for 5 or 10 years experience for grads that didn't have the ability to get that. So you saw that. But then once the universities and the government saw that, you were able to secure other financing and alternative forms of income that are able to support your business, which I think that goes to just show the hustle of the entrepreneur. And really, we have to have a good understanding of the academic framework of raising capital, because these all are potential options. But then when opportunities present themselves, or perhaps you have to create the opportunity yourself, that puts you in a position to get to the next level, which it's been really cool to see.
Yeah, I mean, non-dilutive funding from a founder's perspective is always preferred. It's not always as obtainable, but we've had a combination of both throughout the years, and it has really helped us be in a position to really be in a sustainable kind of driver's seat of how we're trying to navigate the business forward.
And so, yeah, tell me a little bit about the VC round. So what was the driver that made you decide that it was time to go that route? And then how did you and your founding team go about approaching those conversations?
Yeah, good question. I mean, we were starting to notice product market fit in Canada as we were getting some of these large partnerships with RBC and even just direct to school revenue and sales. And we thought, okay, we really wanted to, at the time, this was in 2019, accelerate that growth in the US primarily. We do have some clients in Australia, the UK, and the Netherlands as well, but mainly in the US. Like in our market, the US is the largest higher education market in the world. There's over 5,000 post-secondary schools. For context, there's only about 200 in Canada. So for a solution that's selling into higher education institutions, like the US is really the biggest market for us. So our reason for raising capital was really to grow and expand our higher ed business in the US. And we actually started seeking out, there's a niche of education technology venture funds. There's probably about a dozen or 15 or so that are all the way from seed up to series B, C, D, et cetera. And so we started building relationships with a lot of these different funds along the way throughout the years, not just when we were raising money, but even earlier on when we were in accelerator programs in New York and Boston and a few other kind of just ways we were getting connected to people from some of our angel investors. And when we decided to raise a round, it was really, we were pretty intentional with the types of firms we were seeking. They were all experts in education and education technology. And so basically, it wasn't just going out and finding any venture fund that would take our phone call. It was really targeted around funds that are interested in either social impact from a education to work intersection, like helping mobility of learners be more employable and have better pathways to employability, or they were specifically education technology experts. And so it's a pretty niche, small community. They all know each other, and they were all based in the US. So we started really having those conversations. And earlier on, though, we didn't wait. We didn't start talking to them in 2019 when we decided to raise. We knew the fact that we were on the pathway from our angel round, that venture capital was definitely something that we likely would be doing, and or if we didn't do, it's still good to have those relationships because they're connected into potential customers or employees or other stakeholders that might help us down the road. So we started building those connections early and having conversations. And we did when we got the business metrics into a place that was attractive to a seed, we did a seed round. So it was just over, it was 3.8 million USD from about 7 or 8 different firms. So it was spread out. I think the largest check writer was about $1 million. So they were all relatively small VC checks, which is good from a follow-on perspective, and also just having more stakeholders from different lenses with different networks in the Riipen tent, for lack of a better term.
So you built a relationship in venture labs, which helped you with that initial tranche of investments. And then as you grew your business, you gained more traction within Canada. You started exploring the US. And then did you participate in some accelerators in the US, or were you just connected within those accelerators?
Yep, we did. We participated in a couple different ones. LearnLaunch in Boston is an education technology accelerator. And they actually participated in our angel round, pretty small. I think it was a $30,000 or $50,000 check, but it got them vested in helping us navigate the landscape and connect to VCs, and they're kind of seen as a seed, like a seed accelerator incubator type program that all the ed tech VCs were kind of keeping tabs on. So that definitely helped us. We were in one in New York City as well. So the accelerators are great, but similar to kind of my comments earlier, like it's not if you're thinking of an accelerator, it's not don't ever go do an accelerator because you think it's going to solve all your problems, or it's going to grow your revenue, or it's going to just introduce you to investors. Like those things are possible, it can happen, but you still need to be prepared to go and kind of immerse yourself in that community and actually seek out people that they're giving you access to, and really be in the driver's seat there. They're not gonna raise your fund for you. They're not gonna help you get sales. Like they'll guide you, but you still need to be prepared to kind of take advantage of it. And I also would recommend not giving up a lot of equity to them, just because it is always negotiable. They always say like, oh, it's 6%, 7%, 8%, but in our experience, they are all negotiable. So I would really negotiate that down, because we only ended up giving about 1.5% to, I think, between the 7 or 8 incubators and accelerators we were in collectively. So yeah, this is something to consider. I do have some friends who went down that route and gave up 8% for an accelerator program in the early days of their business, and they really did regret it later on, because they didn't really get anything for it, and that's a big chunk of their company as you move forward.
That's great advice, Dave, because I do hear that quite regularly. Founders will just accept the first offer that's given to them, and it's like when you're getting to a negotiation for sales, you're very rarely going to get the amount you asked for in that sales conversation. So it's the exact same relationship with a potential accelerator. But I love that you essentially own the Canadian market, became the experts in the Canadian market, and then looked elsewhere to which accelerators could provide you the value for that next growth phase of your business. Did you find that some of those VCs, once you did enter the US, after you had accepted their capital to be a part of the Riipen journey, did they end up providing introductions or support some of your business objectives as well?
Yeah, absolutely. And 2 of them are on our board. So this was kind of the first outside people outside of our one angel, our first angel investor, and then the co-founders to come onto our board. So it definitely changed and the whole composition of what working with a board of directors really means, because when it's just the founders and it's not really operating as a board is intended to. So that was a big change for us. Obviously, we closed the round at the end of 2019 on this big plan to grow sales and academic market share, and then COVID hit. So it was a bit of a challenge in terms of especially within higher education institutions. A lot of things got disrupted and they had to move pretty quickly in moving virtual, which higher ed never moves quickly typically. So it was a challenging year and still is a little bit, but our board, and this kind of goes back to finding the right, similar to how we found the right kinds of angel investors who had the right kind of intentions of why they were working with us and the right expectations of where we were as a business. Similar with same idea with the VCs. Like, you don't want to just take money for the sake of taking money or take money from the first person who offers it. It is really important to find people that you believe you can work with and have a healthy working relationship with, that align with your values and your vision of what you're trying to do and build. Because if those are off from the very beginning, it's going to cause ripple effects at some point in time. And so for us, we've been very fortunate over the last year and a half through a very kind of rocky 2 years of kind of a lot of uncertainty in in the world, but just specifically in our landscape as well that we're operating in. The board's been very supportive in helping us think through and come up with solutions and not put too much pressure on only going one way versus the other, like having some of that, like having that North Star of what you're trying to do, but then really kind of having some room to innovate and use the finances to test things and learn and grow the value of the business.
Yeah, that makes a huge difference. Having partners that are involved in your business that care about the long-term goal and vision, and especially you have a social impact component to Riipen, and that the investors don't understand that, and they're just about making short-term dollars, that won't necessarily jive well with founders. Joshua, I'd love to invite you back for Q&A, and I would encourage any of our attendees who have questions to please enter them in the chat box, and we'll get to them. Joshua, I do have a question for you here. What are some of the, and I know you're here representing Joshua Tiong and not the BDC, but on a any business that was going to apply or seek financing from the BDC, what type of metrics does the BDC look at when they're assessing financing for a particular business?
Yeah, great question. And happy to share a perspective. Before I do, I was off camera, so you didn't see me, but as Dave was talking, I was like, yes, yes, yes. Like, to so many of these things, because I was just like, oh, so good, so good. So many gems in there. So I'll kind of highlight a few, and then it'll tie into your question here, Brandon. But, Dave made a few points that I wanted to write down and emphasize. One is building relationships early on. So, life is not transactional. Life is about connecting and finding the right people and going on the journey together, right? Otherwise, like, no business is built alone. Like, no real company, no real difference, right? And significant impact is made alone. You're really thinking about what is the future potential, not of this round, of the single check that's written, but by bringing together a group that there's follow-on potential and we have access to more networks, and they're on side because they're on the cap table, right? So they share equity and upside. So we're tapping into network and expertise and a whole, variety of things that, like Dave said, there's a very niche group of people that are tackling and trying to make a difference in this space. There's also a super key thing, which is, you said that Mohammed was part of your team early on, right? So the angel and anybody who's an investor, a partner, a customer, really, they're part of your team. They're building it with you. They believe in you. They believe in the vision. They believe in the team. They love it and they want it to be successful, right? But the other thing that Dave talked about is, in a way, everything is sales and storytelling. So that early crowdfunding piece was about, what's our story? What's the narrative? How do we tell it? And how do we make it compelling for people? And, as a business owner and as the leadership team, you're selling all day, every day. You're selling to each other. You're selling yourself on the vision and the dream, and that it's possible despite all the, backbreaking efforts that it takes. And you're selling to customers, right? You're selling to partners. You're selling to employees that there's a future here, that we're going to build something that's amazing and meaningful. And the other facet is that everything is earned and everything is negotiable. And in any sort of mentorship or coaching or teaching I've ever done, that's always been like, people make fun of me because I'm just like, everything's negotiable. Your grades are negotiable, right? Bring me a good, compelling case and I will listen. But I may not answer your emails, right? To all students, because maybe your email doesn't require an answer. And so, as a founder, it's important not to try to go after everything. Like Dave said, he was very specific. So, to your question then, Brandon, what does a bank look at? What does and we'll talk about debt, right? So we'll talk about secured debt in this case. So there's a difference between secured debt, which is there's some sort of an asset, right? We have a security legally registered that should you default on this loan that we're providing you, we're going to go after. We have recourse. We have legal recourse in this jurisdiction to go after, let's say, your personal residence or your real estate that you've put up, commercial real estate, or the equipment, right? Because you cannot pay this debt. So there is legal recourse, and any sort of a senior secured lender is going to do that. And then there's unsecured debt, right? Or subordinated debt, which is in between. But unsecured debt really just means we believe in what you're saying, your projections, your strategy, your plan, your team. We believe that this can work. It's a little bit more expensive, right? But it can be more flexible. We can write our own terms. And so this is the spectrum of lending and borrowing. And so the thing to really, really kind of hone in on as an entrepreneur is when you're storytelling for a lender, they are, for the most part, not trying to maximize on upside. They are trying to minimize on downside. And this is super critical. A bank that is lending you money at 7% interest over a 5-year term doesn't really care if you're growing at 100% year over year, right? It cares if you're cash flowing because their money is secure, right? An equity investor, an angel, a venture capitalist, they want your upside to be as high as possible. They're trying to build your enterprise value. So there's fundamentally different motivations and incentives that go into this. So, to your question, Brandon, when talking to lenders, and this can be anywhere on the spectrum of lending, you're trying to take risk off the table. So however you're looking at metrics, whether it's customer acquisition, because when we acquire more free users, we can convert them at some point and we're ready to, but when our R&D is a little bit further, right? It could be, here's our marketing funnel, here's our sales funnel, here's the employee base that we have, here are the LOIs, right? The letters of intent for entering into a commercial agreement with these organizations. We just don't have the ability to deliver on all of this yet. So we can't actually sign this, but they've indicated to us in a piece of paper that's signed that they want to do business. So what you're doing by providing all of this evidence to the bank is that you're taking risk off the table. They're like, okay, like I see it, I get it. You might even have a letter of credit that maybe one of your angel investors says, hey, I will co-sign for this, right? I believe in this company so much that I'll put my own personal collateral, 300K up, right? That is going to be something the bank can secure against if you give money to the business. So fundamentally, that's what a bank is looking at. And so I'll describe the types of risk, and then within whatever the business model, problem space, or kind of company journey is, the founders and the business owners can map to it themselves. So fundamentally, there are kind of 7 categories of risk. So there's product risk, there is market risk, there is management risk, execution risk, concentration risk, financial sector risk or financial risk, and sector risk. So kind of like Dave said, let's say you were in travel or in something that's like extremely disrupted. The sector risk was massive in the last couple of years. When is it going to recover? But let's just say that you're in pet food, right now. Everybody got pets. So the sector is not very high risk. People generally keep the pets that they get. So there's low pet risk. So sector risk for a pet food business right now. So these are the kinds of things that banks are looking for when you're going to them for money.
Makes sense, Joshua, and I appreciate that. So just understanding that, I guess software companies in general are not going to be attracting much lending from banks because they don't have a whole lot of collateral. It's IP, it's digital assets, which banks have a hard time quantifying. So, Dave, I'm curious, did you leverage any debt investment or debt capital throughout the Riipen journey? And if so, at what stages did you choose that as an option?
We have not actually. We've been pretty fortunate that I mean we've certainly tried, and it just wasn't an option for us given the nature of our business and kind of what we're doing. So it hasn't been an option for us. That might change as we move forward, but we haven't gone down that road yet.
Mm-hmm. And I can maybe just jump in as well to say that's on like the term loan side, but I think most businesses have a line of credit.
Yeah.
Right. And so a line of credit is based on how much money do you move through the business at any given time, and something that you can draw down on, replenish, and then continue drawing down on. And the banks will pretty regularly look at your line of credit and give you more room. And you can also ask your banker for more room, right? You can ask for a larger credit card limit. So this is what most companies will use in the early stages.
Yeah, I appreciate that. And it looks like time's actually moved pretty quickly. We've come to our kind of final 5 minutes. So what I might ask from each of you is just to share some final thoughts. I'll summarize some of what I've heard today, but I'd love to just hear if you kind of had 2 or 3 things you would want a founder to take away from this conversation when they're thinking about how to fund their business. Dave, let's have you go first.
Yeah, sure, absolutely. I mean, every business is different. Every industry is different. Every market's different. I think the number one thing that a founder should be thinking about is I don't think you should be thinking about going and raising money before you've even validated or gotten your first customers on board. Because if you raise money and you haven't figured that stuff out, you can burn through it pretty quickly, and you're kind of in trouble right out of the gate. So I think the longer you can wait and the more you can get creative with how you're getting the business off the ground, whether that's all the things we talked about today. And then once you feel that you're at an inflection point where you've gotten enough traction and you actually know what you would do if you raised $1 million, $2 million, whatever it is, at that point, you should actually start thinking about how you would tell the story and how you would position the business metrics for doing that. But then again, the biggest thing is finding the right fit of the people you take money from, because you are bringing in team members, like whether you like them or not, like they are going to be involved with your business. And it's just a much more, you lose less sleep and get less gray hairs if they are working with you and collaborating with you and challenge you in a productive and positive way versus a confrontational and negative way.
Thanks, Dave. Over to you, Joshua.
Yeah, completely agree with all that. I think if I were to end off on one thing, it would be, as a founder, the most important thing is to be clear. And more importantly, to be clear with yourself so that you can be clear with others. And there is an order to the madness. It is madness every day, whether you're starting out or you're leading a $200 million revenue generating company that has an amazing team. It's just chaos. It's always chaos. That's the nature of being at the helm of an organization. However, the founders and the business owners that I work with that I most admire are the ones that are clear. And so I'll give you one example of how this manifests in being a founder. Is one founder always knows, here's what I'm trying to do right now. Here are the things that need to be done. And which of my big, bold steps does this contribute and cascade up into? So what is the objective we're trying to accomplish? And we know these things matter because they map to our vision and our mission. And like these are real things that are important. And they're never afraid to ask for help, right? It is not a sign of weakness. It is a sign of strength and humility that you are asking for help. So every time I get an email from the founder, I open it because I know that they are respectful of my inbox. And they might say, hey, we just released this new feature set. We're looking for these kinds of people to give us feedback. right? They're specific about their ask. They make everything easy for me, right? They're like, hey, want to respect your time. We're looking to, meet this person right now. I've, want to be respectful. I know that you're connected to a few. If you're comfortable, are you able to make an intro? If so, I'm more than happy to write a first draft. And from there, you can use that if it's easy. Make it easy for others to help you, because God knows everyone wants to help. Everyone knows how hard it is. Maybe they don't appreciate it at the same level, but they know it's hard and they want to help. And maybe that's like predominantly Canadian, but most people want to help. And if you can make it easy for them, they will absolutely put in the effort. And give people an out, right? If you're asking for something, and don't make them feel bad about not having the time or the attention to be able to do it. But it's kind of the Gretzky thing. You miss 100% of the shops you don't take.
Thanks, Joshua. And on that note, we are at the top of the hour, so I want to be respectful of both of your time. And thank you very much for sharing it with us today. Thanks to our attendees for joining us. And we'll be circulating this virtually to everyone afterwards. Thanks so much, Dave. Thank you, Joshua. Enjoy the rest of your day.
Thanks, Brandon.
Thanks, Brandon. Thanks, Dave. Take care, everyone.